First, we want to bring in Bob McTeer, the former Dallas Fed president, current fellow with the National Center for Policy Analysis and a CNBC contributor. Also, Rod Smith is a chief investment strategist at Riverfront Investment Group. Gentlemen, good morning to you. Bob, I'll begin with you. How does this square with your expectations going in?
Dead on, I think. That's what I expected. We heard from Gentle Ben rather than Hurricane Ben. I would point out, though, that the choice in monetary policy isn't between QE3 and doing nothing. I mean, you can have monetary policy as we used to have it, where they control, they influence the growth of the money supply. So no QE3 right now does not mean that the Fed's just backing away and not going to do anything. I think the extra day on the meeting, usually when they do things like that, it's to have a little seminar. It won't be an extended discussion of what to do so much as staff presentations on the possible alternatives that are available to them.
Rod Smith, we are sitting close to session lows right now. The S&P is down by 1.9%. Is this a case of selling the news? Because it sounds like what Mr. Bernanke said was pretty much what a lot of market participants were expecting, which was largely not much.
I think that's correct, but there was some lingering hope that he might have some rabbit to pull out of the hat. I also think, if I may say, that all of this attention has been on Bernanke because, of course, he is speaking, but he is the one known policy maker in this whole terrible Greek drama tragedy that we're playing out. It's the ECB, the European government, and the U.S. government that are the ones that we don't know on. And I think what I heard, I thought Bob's point about Gentle Ben and Steve's points are just so important, which is that there comes a moment where the Fed says, you know, I'm not Hercules, I'm not Atlas, I can't hold up the whole world. And talking about the fact that the economy has been okay is not reassuring to investors when the recent incoming economic data is getting worse. And so I'm much more focused on what's happening in Europe. I think that the DAX has made it to a new low for this decline, and I think the S&P will too. In other words, I don't think 1120 is now going to hold. And so all of that needs to be put in the longer-term context, which is, as I heard on the program earlier, there are some extraordinary valuation issues. But if you're a trader today and you were flat going in, you may be willing to go into the weekend short.
Bob, if Mr. Bernanke is attempting to withdraw very slightly, is that because you think he wants other people to fill potentially a vacuum there, i.e. the policymakers on Capitol Hill, or because increasingly we're realizing that central bankers aren't demigods and they're now talking about these permanent issues, housing and the financial crisis that cannot be stimulated?
Well, I think you make a great point, Simon, and you know there are limits, and you know if you're a dove, Bernanke has done many of them. The one thing he might have announced today was that he was going to suggest to raise interest rates on the reserves of the banks to try and force them to lend. That may come out in September. But again, I think you've been dead on, Simon, in the attention here is Europe and the DAX down 6% in 2 days and breaking to new lows, and the fragility of Europe. That's the issue for me as a global investor, and I think the U.S. is a relative safe haven for that money that you're going to keep in risk assets.
All right, let's, guys, stay right there. I want to bring in Bob Pisani with a reaction from the floor here at the exchange. Bob.
You know, it's very interesting because the consensus is often wrong, but this time they were absolutely right down the middle. This speech could have been written by just about anybody I talked to in the last 3 days. So an informal poll this morning, I said Bernanke does nothing or no new policy pronouncements. What happens? Dow down 200 to 300, the S&P down 25 to 30. That was kind of the consensus. And look, that's almost exactly what's happening. One thing that concerns me a little bit is I did not see any whoosh when the announcements were made. I didn't see any dramatic volume push up. In fact, the volume is not particularly heavy. That suggests to me not an awful lot of selling going on, a little bit of good news, but also no interest in sort of buying now that the Dow is down 200 points. That may indicate people are just going to sit on this throughout the rest of the day. In a sense, when I asked some of the guys down here what's going to happen in the next day or so, a lot of guys mentioned Trichet, and some people down here seem to think he's actually going to hint at lower interest rates, and maybe Steve can address that issue, what's going ahead. But finally, the toss to the Congress and the president, that was a brilliantly timed expectation with people down here. They think the payroll tax extension is a foregone conclusion. Some kind of housing suggestion, housing bank, something like that. That's also talked about a lot down here, guys.
Forgive me, Carl. I think, Bob, if I may say something, as somebody who is managing money, literally, seeking to make decisions as this data comes out, if you look at the primary trends, the new primary trends of all markets, they are towards reducing risk.
Yep.
And we've been in a bounce, and the issue was how far could the bounce go, and could anything come out of Jackson Hole that would give the bulls some life. And I think the reaction that you're seeing is that people like us who have dry powder, who want to buy, who are actually quite significant long-term bulls of equities, are saying, I don't want to buy at these levels.
So 1125 is where people have been buying recently. When it gets down there, that's where the money's been. But you're right. I mean, we're not seeing a lot of buying interest right now. The question is, I throw it on the other side, is the selling interest exhausted? And that in itself would be some signs of good news. Wouldn't you agree? Even if you're not interested in buying, just to see the selling pressure exhausted.
I think the selling pressure can be exhausted on Bernanke, but we're going into a weekend where all the focus, now that it's going to come off Jackson Hole and go straight back onto Europe. Let's bring in Rick Santelli, who's obviously watching the bond market.
I want to just offer...
One small thing, Rick. I thought, just on the question of what consensus was, I thought we might expect them to lay out the sort of things that they were thinking about, those extra measures that they clearly discussed at the last meeting. And obviously that isn't in what we've got today, Rick.
No, as a matter of fact, even though it was subtle, talk about the twist, the Kennedy administration side where they're interacting with short and longer maturities. When you're at 20 basis points on a 2-year and you get down to 18 basis points, it doesn't sound like a lot. But yes, the market was actually anticipating some type of jelly bean swap in terms of the relationship between short maturities and long maturities. It didn't seem to happen. And once the Dow hit down 200 points, Simon, it's like a red flag goes up in front of the fixed income traders. That's when you saw the 10-year get down to like 212. That's when it looked like you were going to go under 3.5% on a 30-year. And even though there are bounces in yield, there's a sell-off in price has occurred since then. It really, at this point, becomes a weekend event, as our guest was talking about, and kind of which side of 200, 250 points the Dow closes, because fixed income traders are the relief valve, the pressure valve. If stocks are going down, they want to be long a few extra treasuries.
I want to give Steve a chance to ask a question really quickly, but if you don't mind, Steve, I just want to bring one point in about that Krugman made this morning in the Times and ask McTeer about this. Krugman writes, Bernanke accused the Bank of Japan of suffering from self-induced paralysis. Well, now the Fed is suffering from externally induced paralysis. In effect, it has been politically intimidated into standing by while the economy stagnates, and that's a very, very bad thing. Do you think this had anything to do with pressure from Rick Perry or anyone else, Bob?
Well, I doubt it. Paul Krugman has all along said that the Fed and the fiscal policymakers have been very much too timid, that the stimulus wasn't large enough, and he's out there on the extreme of that point of view. But he does have a point that you got to go in there with shock and awe and do things in large scale. And he has a point, but I don't think most people would go as far as he does. May I say something? I think it's more important right now that the ECB be a little more dovish and a little more activist than the Fed. And I think it's a good thing that Trichet, and I believe his successor is supposed to be at Jackson Hole as well, the academic types that usually speak there, and remember, Bernanke is not the only speaker, they tend to be more dovish than the market types that are generally on CNBC. So I think they'll get an earful of advice to be more activist.
Mr.
And
McTeer.
I think if the ECB would step up better. Yes.
But Mr. McTeer, if you say that central bankers in this situation have to react with shock and awe, what do you expect Trichet to do? What more could he do? Because presumably a 50 basis point cut on interest rates is not shock and awe, from what you're saying, inferring from the type of action that you think is warranted in this environment.
Well, I was reading David Malpass the other day, and he was saying that the bond purchases of the ECB are about a tenth of what they ought to be. That when they buy these sovereign bonds, they need to be going in and buying larger quantities and doing things in a bigger way than they have been.
So, Steve, is Mr.
I would absolutely agree with that. And Simon, I think if you want to know what, as an investor, we would look at as shock and awe, it's all about the ECB's balance sheet. They've been buying bonds, but they have not been increasing the size of their balance sheet.
Because that's not the role of the ECB, as you know.
Are about their balance
that's not what they're
sheets
set up to do.
Yeah. Steve,
no, and that's why we're so worried.
I hear you.
Steve, is Mr. Trichet going to signal some kind of interest rate cuts tomorrow? What is he going to say? Because that's what the guys down here want to know right now.
I don't think so. I think they're probably off the bandwagon of raising rates. I have not heard any discussion about him actually signaling lower rates, especially with the fact that he is going to be leaving soon. But I want to come back to this issue of, the outlook for QE3. When I think about what Bernanke said today, he maintained the status quo from the August 8th statement. He didn't advance the ball, but he didn't really send it back any further than it was. And so I think it's useful for markets to think about where we were on August 8th. They downgraded the economy. They put forward a pretty historic prescription for the economy, which was to pledge to maintain interest rates low till mid-2013. Bernanke didn't further downgrade or pretty much upgrade the economy very much from there. And you'll remember from the August 8th statement, they also put on the table the idea of consideration of additional policy tools. What Bernanke did do today is say, you know what? We're going to have a pretty good discussion about that in September. So I'm not sure we're upgrading or downgrading the chances of this from the August 8th meeting. The only thing I was saying was that if you think it was going to happen today, it didn't happen today. But I think the status quo remains of the possibility of it into September. So we're going to watch two things. We're going to watch the incoming data to try to get a little more clarification about where the economy is headed. Is this a recession on the edge here, or was it just the temporary factors working their way out? And the second thing we're going to watch is comments from other Fed presidents, especially the voting members, to get a sense of how much support the Fed chairman would have for additional action. So those are going to be, I think, the two keys, the data and the comments from other Fed speakers to see what kind of support there is for pushing the ball further ahead.
All right, guys, we've got to leave it there. Thanks so much for all of your time. Bob, McTeer, Rod Smith, of course, Steve out in Jackson Hole, Rick, Fob, the whole gang.